All right, everybody. Today is Thursday, April 7th. It's the first day of the Masters. Tom, you're a big Masters guy. Who do you have winning the whole thing?
Yeah, I'm going with Justin Thomas. I think John Rahm actually is technically the odds-on favorite. I think he's got the lowest odds, but I do think the golf guys owe him a few favors. But I just don't think he's going to get it done. I've followed both a little bit over the weekend, and Justin Thomas looked outstanding. If you want a super deep cut, there's a South African kid named Garrick Higo, who I think is like 120 or 140 to 1. I think he's got real talent. I followed him around for a little bit the other day. And then in terms of low amateur, I put my money on Jarvis. He's a kid from the Cayman Islands, which has exactly 1.5 golf courses. And he's made it all the way to be an amateur at the Masters. So, in terms of guys I would be rooting for in the non-professional rankings, that would be my guy.
Awesome. Thanks, Tom. On to other things, economics primarily. We do have initial jobless claims this morning. Initial jobless claims came in unbelievably low. There were only 166,000 new claims for unemployment over the last week. That was down from 171,000, but the initial estimate was 200. So, I can't really remember 166,000 on the new jobless claims front. So, we're fully back on the employment side. I don't think that's a surprise to anybody, but it does reiterate the strength of the economy and the tightness of the labor market at the present moment, which leads us perfectly into the next topic that we got today, which is a recap of those Fed minutes yesterday. The Fed has really hit markets over the last 2 days, and you had Brainerd, one of the Fed governors and potential vice chair, coming in, and she was very hawkish on Tuesday. And then we had the minutes yesterday, which were also hawkish. Tom, give us a quick summary of what's going on in those minutes, why they were hawkish, and then what you think the next steps are.
Yeah, I think to your point, despite being what I would say is probably the most hawkish Jay Powell's been year to date, classic art of the deal, a little bit of anchoring going on. Lyle Brainerd came out and was more hawkish than anyone expected. And then Jay Powell came in pretty hawkish compared to where he's been, but in relation to what we heard the day before, was a little bit more dovish. And I think that helped to stabilize the markets just a bit. I think it was less of a surprise than maybe perhaps it would be. And maybe that's a little bit of gamesmanship on the Fed's part. I've got my notes here on my phone here because I had to move to find some internet for the call. But, the essential details are that they're going to be running off $95 billion from the balance sheet, which was really what we were looking for. How aggressive are they going to be in terms of monetary tightening in relation to the balance sheet? So of that, $60 billion is going to be treasuries and $35 is going to be mortgage backs. We've already seen mortgage rates really shoot up. So if we're seeing them actively selling mortgage-backed securities, that's probably going to continue to be a spot of weakness in the fixed income market. Particularly if you think anybody who got a mortgage and is, actively paying their mortgage and is going into somebody's investment account, say they're paying, 3%, all new mortgages are coming out are going to be higher, and therefore the old ones are going to be less attractive in terms of yield. And not only that, but the speeds, which is how quickly people pay back their mortgage, is going to slow down significantly because the number of people who are going to be refinancing a 3% mortgage and replacing it with a 4% mortgage is going to be a lot less. And so you're just going to have a double whammy in terms of, what you've got is going to look bad and what you've got coming out is going to look better. And then the next day, if rates continue to rise, the new stuff's going to look even better than that. And so it's going to be sort of a falling knife situation, I think, in mortgage backs for a while. But, eventually there's going to be an opportunity there, I think, in terms of starting to wade back into that area of the bond market in search of some yield.
Tom, to that point, they're going to try to sell 35 billion or get rid of $35 billion of mortgage-backed securities every month on their balance sheet. Do you think because rates are high, you're not going to have the refinancing? You already have a relatively slow movement in terms of prepayments because people aren't really selling their homes. People are trying to buy homes, but there's no inventory to buy. So home sales aren't going that fast. And you're not going to have that refinancing boom that really allows those mortgages to run off faster. So do you have any qualms? Will they need to be selling these mortgage-backed securities in order to hit that $35 billion number?
No, I don't. I think that I mean, it needs to be done. They really need to get ahead of where they are. And Sam Zell, who's a noted private equity titan and goat man, if you want to do a quick Google of Sam Zell and listen to his voice and how he looks, he's an all-time CNBC character. But he basically said that the Fed is about 6 months behind. And so what they're doing right now is trying to catch up. And so, they basically said, we were going to do 50 basis points for the first hike, but then the war in Ukraine, basically said, hey, everybody, let's crank it down to one hike and see what happens next. So I think the expectation now is that we're definitely going to get two hikes. To Sam Zell's point, I think they need to be a little bit more aggressive to get to where they need to be to stem inflation. Obviously the worry, of course, is that they're going to go too fast and there's going to be a hard landing. And I think that's something we're definitely taking into account. But I think to take some positive news out of it, what we did see and have seen really since Lyle Brainerd spoke is we've seen significant steepening on the yield curve. We've seen, in fact, the short end of the curve was actually green yesterday, which you think would be counterintuitive because, that's where the hikes are going to be baked in the fastest. But I think we've already seen so much selling there that we're probably about as oversold as we could be on the 2 and 5 year. And so now people are starting to sell their long bonds. And I think that's more of a healthy move for the yield curve. It's more of a natural move for the yield curve. And so we're all the way back up. Last I looked, and I'm only working on one monitor here, we were at about 20 basis points on the 210 spread, which is wild because we were inverted pretty much all of last week. So we're seeing some serious moves there. And I think that's going to bode well for performance. And I think that's, if anything, I think that's the positive lining is that we're seeing a natural move on the yield curve, which ideally is what the Fed would want is normalization. And that's kind of the way we're moving. Obviously things change very quickly. We changed from being inverted last week, but we're now seeing some steepness in the yield curve, which I'm taking as a green light, at least in the short term.
Awesome. Thanks, Tom. Yeah, I think we're definitely watching for if the Fed is making a policy mistake. They're inking themselves into more hikes and being more hawkish than I think they had planned on inking themselves into. Part of the policy itself, one tool, they talk about they have quantitative easing as a tool. They talk about raising rates as a tool. They also say their rhetoric is a tool to tighten monetary policy. And certainly we've seen that. They've only hiked once and they've significantly tightened monetary policy because they've given all this forward guidance. Problem about giving forward guidance is it's easy to give, it's easy to use the tool, it's really tough to take it back. And I think that's what we see with Fed policy in general, but it also goes for forward guidance. And so they'll have to really navigate this. Again, we're calling the macro presentation the narrow gate, and it's an extremely narrow path that the Fed is going to have to tread in order to sustain this. Having said that, we got the jobs number this morning, the new claims for employment, very low. And I was looking at some credit card data, and the credit card data is actually holding up fairly well. I know we've had all these issues in the world of freight, but the credit card data itself is actually holding up. And that comes in context of a much earlier Easter last year. Last year, Easter was on April 4th. This year, it's not till the 17th. And that has an associated increase in spending. It also brings forward the spending that happens for the spring and spending that happens for the summer. On top of that, you're comping over the period in which we got the March stimulus payments from last year in terms of the checks that the administration sent out. So you have both of those factors working against retail sales, and card spending is actually holding up decently well. And again, we'll look into all the detail in the macro presentation on Tuesday, but that kind of gives you a qualitative assessment of where we are. If you want the hard numbers, we did get Costco's numbers last night, and Costco was extremely strong, much better than I expected. They're benefiting a lot from gasoline prices, and people also just trying to find the cheapest gallon of gasoline, which you can find at a Costco store. So Costco is performing very well as a result of that. But again, Costco has a difficult comp because of the stimulus checks and the earlier Easter from last year. And they posted a 17% same-store sales growth in the last 5-week period. That comes against the estimate of 11%. So up 17%, estimate was 11%. It was led by food and sundry items. That was up in the low to mid teens. You had fresh foods up in the high single digits and ancillary services up in the mid 50s. The ancillary services, of course, things like Costco travel, really accelerating nicely, which is helping their business. So overall, I think that we're actually seeing some momentum on that retail sales number. And I think it's just going to continue to embolden the Federal Reserve to continue to tighten policy. I attended at a Georgia Tech thing with Dennis Lockhart, a former Federal Reserve member. And he said, you just keep pushing the envelope until the envelope pushes back. And right now the Fed is definitely very much pushing the envelope. And right now the envelope there's some firmness there, but it's not pushing back that strongly. Tom, how do you think Jim Bullard will address that today when he talks at 2 p.m.? He's a Kansas City Fed.
Well, I'd be interested because he likes to go against the grain. So if the Fed is being extremely hawkish, maybe he'll change his hat and go extremely dovish. So that's not probably a realistic outcome. I think that he's probably going to continue to push the narrative of accelerated tightening, accelerated runoff. He's always due for a surprise. So what that could be is kind of tough to say. He may say, hey, maybe we'll do three rate hikes in the May meeting. There's always something he's got up his sleeve to move markets and have people talking about him. So what that is today, I guess, remains to be seen. Hopefully it's not too much of a splash. It's already been quite of a volatile week, and about to sneeze. I'm going to mute up.
All right, thanks, Tom. In other news, Meta, Facebook is launching Zuck Bucks. They're looking at this internally. It's what the employees are calling this initiative. Zuck Bucks is going to be a virtual currency, but it's not going to use crypto or blockchain. Meta will control it internally. It's going to be able to buy products on Facebook, buy services on Facebook. They may also create these things called social tokens or reputation tokens, which would be issued as rewards for, quote, meaningful group conversation contribution. So if you interact on Facebook or Instagram, you could get these reputation tokens, increase your reputation, maybe get some virtual currency, maybe get some Zuck Bucks. Separately, Facebook's also exploring traditional financial services like lending to small and medium-sized businesses. Tom, any thoughts on where you think Facebook's going or Meta's going with all this? Clearly, they're trying to build out the metaverse. Part of that is having a separate currency as well. But I just don't know if it has any traction.
My first thought was perhaps it's something almost like, the gift card economy, which is, companies like Starbucks make a ton of money on gift cards in the sense that you put your money into their system, that cash sits on their balance sheets and generates income for them. So if you get enough people who are interested in having some Zuck Bucks on their personal balance sheet, they're basically saying, here, take my money, put it into Facebook's system, and then I'll use it when I want to. But all that money sits on their tab and accumulates interest. And I think that's an interesting piece of it. The second would be to the content creator tokens. My thought would be that one of the things that Facebook doesn't seem to have that other platforms have is sort of influencers that are specifically associated with Facebook. You talk about TikTok stars and Instagram influencers, but nobody's like, man, I follow this one guy on Facebook and he's awesome. And I think that that's maybe the impetus there, which is that you can start to essentially compensate people to be Facebook specific content creators, which is driving eyeballs back to Facebook, which has sort of lost a lot of that coolness factor over the last couple of years. So how effective that is, I'm not quite sure, but that's kind of my thought in terms of what the reasoning is for those specific tokens. But I guess we'll kind of see as it rolls out, because with a lot of these things, they don't always work out exactly as planned. I mean, I think we can all go back and think about Google Plus, which was supposed to kill Facebook, but turned out to be a complete flop. And so trying to change the direction of Facebook is going to be a pretty monumental task, I think, in terms of how people interact with it. I think everyone's pretty much ingrained with their own personal Facebook strategy.
Excellent. One last story, Berkshire Hathaway bought a $4.2 billion stake in HP. It now owns a little bit more than 11% of the company. This follows Warren Buffett's big foray into IBM in 2011, and then which was a terrible investment, and then also Apple a little bit later on, which was a great investment. So where do you think this investment in HP stacks up in Warren Buffett's tech forays, Tom?
I mean, I was looking at this morning. It's kind of a head scratcher because HP has sort of been maligned for quite a bit of time. I mean, they made some terrible acquisitions back in the early 2000s, moving hard into laser jet printers when everybody was moving to a more digital, scanners and email situation. Then they split into HP and HP the enterprise system, and so it's kind of been one of those lost companies that used to be a heavy hitter, but no one really ever thinks about it anymore, which I think is really, in the bag of tricks of Warren Buffett. He's looking at a company that's existed for a long time. They've got a lot of profitable businesses, but nobody ever thinks about them. And I think that has pushed a lot of money away from that stock in terms of, where it could potentially be. And so, in classic Warren Buffett style, I think there's definitely legs there. The question is, can the business perform? I mean, he's had some stinkers, like Wells Fargo has been a thorn in his side for a long time. American Express for a time was a thorn in his side, but they've really turned that situation around. So definitely something to keep an eye on. Maybe as a company we need to have some more eyeballs on, but it's just one of those companies that was very, very hot in 1995 to 2005, and nobody ever talks about it anymore.
Yeah, I think it would have been a much better investment, when people were buying computers and aggressively rebuilding out the offices. But I think right now a lot of that's come off. You're seeing stuff from Intel saying, maybe things are just a little bit slowing on the PC side. So I don't know if the timing is great. I think the valuation point, I think he has a good point, but it's also up 14% this morning. So with that, I think there was one person who hopped on late. Tom, who's the one to watch? Keep an eye on today at the Masters?
I think Justin Thomas has got it. I think this is his year. If I had to put money on it, which I haven't yet, but I think they've already teed off. I think Olazabal went off at 8:30, so I think I missed my betting window. But that's who I think has got in the bag this year, if I had to pick a golfer.
Awesome. Thanks, everybody. We'll see you here tomorrow at 8:30. Bye.